This is Increasing Alpha TV. I'm Scott Fullman, here to talk to you about the potential implications of the energy meltdown on both the market and the economy. As many of you realize, stocks in the Russell 2000 index have been under a lot of pressure this year. For the second time, we are now seeing that the Russell 2000 index has entered the official correction mode status. This is sort of a breakaway from large cap stocks, but it has had its implication on large cap stocks as well. From peak to trough, the Russell has dropped 10.2%. That puts it into official correction mode. The S&P 500 and the Dow have both been down 3 to 4 and sometimes up to 7%. We could call that an untraditional or non-traditional correction. But as you can see, small cap stocks definitely have been taking it on the chin this year, being both very volatile and under bearish pressure. Large cap shares continue to rise while small cap shares were rolling over. The S&P 500, the Dow Jones Industrial Average, the two major benchmark indicators of large cap shares, have failed to reach the official correction phase and are very overdue for such a correction. In fact, it's basically been more than 3 years since we've seen the S&P 500 reach official correction phase. That's unheard of and unprecedented. So it gives us reason to exercise caution. Some reasons for the split between the large cap and the small cap arenas. Small cap shares are more growth oriented, while large cap are more value oriented. Anticipated increases in interest rates will impact the smaller cap stocks faster than they will the larger cap stocks. There are also indications that the economy may be slowing in its growth rate. Large cap shares tend to benefit from the investments that they have in the credit markets, especially since they use capital that's derived from those credit markets to help fund stock repurchases. They use them to increase dividends, and they also use them to fund acquisitions. Additionally, they have competitive advantage because their growth gives them the opportunity to borrow money at lower rates, even in the junk markets. Large companies also have purchasing power, meaning that they can turn around and buy stuff much cheaper than smaller companies, which helps their margins. Pension and fund managers have been staying with the larger cap issues because they are a little bit more secure and less volatile. Again, small cap equals higher volatility. There are several factors pointing toward a slowing of economic growth. First, despite the fact that we saw a nice jump in non-farm payrolls for September, July and August were basically lower than expected, a bit of a contraction of the growth rate, not of growth itself. Additionally, there are other factors impacting the markets around the globe, such as the geopolitical factors of Russian sanctions, which are slowing economic activity into and out of Russia. There's also now a focus on terrorism and having to secure the movement of goods and services around some of these terroristic threats. Interest rates remain low and continue to decline, but the U.S. dollar has been rising, and this is partially because it's a safe haven. Now, one of the factors is when the dollar is rising, it makes it easy for U.S. citizens to import goods, but it makes it hard for U.S. companies to export goods since the cost of those goods rises. Commodity prices also are falling partially because of the dollar and because demand for energy and inflation rates still remain subdued. As the chart shows, crude oil futures continue to decline and actually set a lower high back in July. We are now declining below the $90 a barrel level for light sweet crude oil. We're also seeing Brent crude coming in toward the $90 per barrel level, and this is putting downward pressure on oil prices and gasoline prices. As the chart shows on crude oil inventories, almost 400 million barrels of crude oil have been stockpiled at the beginning of July. While we have tapered off a bit, they still remain relatively high, which is putting downward pressure on oil prices. This is partly due to the fact that demand out of China has subsided a bit, and also because we're seeing a shift in demand from crude oil toward natural gas and toward alternative energy sources. With the exception of food, inflationary pressures remain low, and that has caused gold futures as well as silver futures to plunge. The fact is, we've also seen the stocks of gold and silver related companies down sharply this year. This is putting pressure on the materials sector as well as contributing to some of the weakness recently in the market. So, why are the S&P 500, Dow Jones Industrial Average, and Dow Jones Transportation Average holding near their highs? Well, first of all, the credit markets are keeping those benchmarks higher. As we mentioned earlier, the repurchase of shares in companies of those using the credit markets, purchase of other companies, the reduction and refinancing of longer-term debt, increase in dividends, as well as creating operating capital are contributing to those companies' bottom lines. Also, we note that there is a lot of loans being made by those companies, especially in the financial sector, and we are also seeing that those companies are benefiting from using leverage for increasing buying power. There are some major advantages to being a large cap or mega cap company versus being a mid cap or small cap company. We also want to mention that pension funds continue to look for opportunities to buy in the market since interest rates are low and they are looking for growth in excess of 7%. Basically, the only place to find that is in the equity markets. Using the large cap and mega cap groups, they tend to lower risk and expand the opportunities for profit. So right now the dollar is strong. Commodities continue to deteriorate. We see small caps remaining vulnerable and underperforming their larger cap cousins. And the large cap shares, though, are overdue for a traditional correction, keeping us defensive. In other words, we're still in the market, but we're taking very great care to protect our capital. Energy and commodity-related shares are holding back a lot of the other sectors and groups. For example, we see that in the commodity space, the precious metals related stocks are down, and they're pulling down the basic materials group as well. Implied volatility and risk perception are slightly elevated at this point, especially due to seasonal tendencies and the fact we are about to start the third quarter earnings reporting season, which is very, very important as analysts look for comments from CEOs and CFOs about the prospects for 2015. We believe that short-term risk levels are high. The probability for a correction is also high. But again, while a lot of people have sat out waiting for these corrections, they've missed valuable opportunities. The probability for a broad bear market is low. This is due to the fact that interest rates are low and that the yield curve remains positive. Our intermediate term and long-term outlook is positive, but we note that risk levels in the short term are high. So, how do we play it from here? Well, the first thing is we like to hedge or partially hedge portfolios for the next several weeks until we get out of the seasonally dangerous period. Bear put spreads are favored because the sale of a put against the long put helps us to reduce our cost as well as control our risk on spending capital for the hedge. We're also suggesting for those who are looking to get into shares, writing out of the money puts, being the fact that implied volatility levels and risk premiums are higher, we can take advantage of those premiums and create strategies that allow us to benefit from the stock staying above the strike price while also reducing our cost of owning the stocks should they drop dramatically. Again, it's all about creating the strategy. Additionally, we're also suggesting that if you have positions in stocks that have risen over 10% since you purchased them, consider the idea of reducing some of those positions or the use of stock replacement strategies. Give us a call for details. We'll come up with ideas for you. As we end this presentation, we remind you that year to date, our track record has been that we have basically 77% of our ideas have been winning ideas, with an average return on all ideas close to 38%. If you're looking for ideas, you're looking for strategies that give you higher returns, lower capital risk, and improve the probability for success over a greater range and direction of prices, check us out at increasingalpha.net. I'm Scott Fullman. Thanks for watching.